Good afternoon, everyone. I welcome you all. A very warm welcome. Good afternoon, namaskar, sat sri akal, vanakkam, kem cho, etc., etc. So, I'm C. Ankit Sharma, your income tax faculty for today's session. And today we will be discussing the provisions of income under the head capital gain. This is our second class for this specific topic, that is capital gain. In the last class, we have discussed the basic things of capital gain, like what is the chargeability section of capital gain. That was section 45. And it says when there is a capital asset and when there is a transfer, that will result capital gain or loss. Then we have discussed the definition of capital asset under section 214. Then the definition of transfer under section 247. Then we have discussed what is the short-term capital gain and a long-term capital gain. And due to an amendment in the definition of long-term capital asset, that is, it is different before 23rd of July 2024, and it has been changed from on or after 23rd July of 2024. So the long-term capital asset and short-term capital asset classification is different before that certain date, and it has been changed after that certain date. And it has multiple implication on the indexation provisions also, on the tax rate also, etc. So we have discussed the definition of short-term, long-term capital asset. Then we have gone through with the provisions of indexation. What is the meaning of indexation? How to implement the indexation process and the index rates, etc. The formula regarding the indexation. Then we have seen that the indexation before applicability of indexation before 23rd of July 2024 on those long-term capital asset, and there are certain long-term capital asset on which indexation was not applicable if that is even before 23rd July of 2024, like in case of depreciable asset, bonds, debenture, etc. In those cases, even it is a long-term capital asset, indexation would not apply earlier also. And on or after 23rd of July 2024, now indexation is not applicable on any long-term capital asset except a immovable property. An immovable property which has been transferred by individual or HUF. Only indexation is applicable in this case, but there was a twist that for the purpose of gross total income calculation, we will not provide indexation on even this immovable property. The benefit of indexation would be only available at the time of calculation of tax. So if you will take the benefit of indexation at the time of calculation of tax, the tax rate would be 20%. And if you are not taking the benefit of indexation, the tax rate would be 12.5%. After that, we start discussing the provisions of cost of acquisition, in which we have discussed the intangible asset provision, like goodwill of business, trademark, goodwill of profession. And let me clear once again that whether those case number A or B, that was regarding intangible asset, goodwill of business, trademark, or goodwill of profession. The cost of acquisition would be same as per the chart we have discussed, whether that asset have been purchased before 1401 or after. There is no concept of comparison with the purchase price to the FMV. The comparison of FMV with the purchase price is starting from third category, from shares and other asset. It does not have any applicability on case number A and case number B, because in examination, it's the probability that they might give you FMV on 1401 in case of trademark, copyright, goodwill of business. Suppose the question says like this. Might be the question says that suppose Mr. A purchase a trademark for rupees 5 lakh on 1st October 1998, and the FMV on 1st April 2001 was 7 lakh. So you might going to compare it and you might going to take higher as the cost of acquisition, but that is not correct, because in case of trademark, this FMV concept does not applicable. So please keep this point in your mind always, that in case of A and B category as shown in the chart, like intangible asset, there is no comparison provisions are there. Then we have discussed the concept of shares cost of acquisition. In that case, we have discussed ordinary shares case cost of acquisition, bonus share case, and we were on the right share case provision. And after that, we will discuss the other asset case. Fine. So that was the recap. So a lot of good morning wishes already uh, is here. So, okay. Lahari Maroju, good afternoon. Pooja, good afternoon. Neeru, good afternoon. Hardik, Preeti, Tambeshwari, Nitin, Abhishek, Shruti, Anuradha, Sukhbir, Pranav, Deepak, Vaidehi, Manvi, Karan, Bhumika, Kushi, Jinki. Very, very good afternoon to all of you. And I believe that you must be studying very, very hard to achieve the goal of your life, that is to become a chartered accountant as soon as possible. So before starting the class, the thought for the day is in front of you. And it says, tough times never last, but tough people do. So how beautifully the quotations have this special characteristics that they say a lot of things in just one phrase or in just one line or in just one sentence. And you can feel that by this quotation or by this thought that tough time never lasts. Of course, it's true. Your struggle will never last. Of course, it would be over after some time if you are actually working hard for your goal. So if you're a tough people, if you're a tough person, if you are ready to do the hard work, then your tough time would never last. It would be over as soon as possible, depending upon your hard work, etc. So that was the thought for the day for all of you. And let me tell you, these are not thoughts, these are actual things. And these does matter if you just believing that these are the quotations I'm sharing with you just for the sake of these quotation. No, these are the experience of life and they do actually affect it someone's thought process. So if even one of them, one of you is going to be affected by any of the quotation and start changing your behavior. So that was the whole purpose of this sharing these quotation with you because I believe in these quotations. These are technically affect me and I always believe in them and I always try to follow that. The tough time never lasts if you are a tough person. You will fight and you will come over it. Okay. So, okay. Hardik has some doubt. Before that, B Sai Kiran wants to ask something. Sir, this share FMV first revised on 1401. Subsequently, the same was revised as on 31st January 2018. I have shown in the chart also that there is separate provision for these 31st March 2018, 31st January 2018 case also that we will discuss in detail. For the time being, you should understand that we need to compare that FMV if you have purchased those shares before 1/4/2001. For those shares, those having the separate amendment has been come, those are specifically on which STT has been paid, etc. Separate provision that we are going to discuss later in this topic. Okay. Hardik is saying, sir, if any new amendment, if any asset purchase, including land and building after 23rd, then no indexation benefit. There is indexation benefit. If you have purchased after, then there would be no indexation benefit, correct? So if any land and building bought in 2018 and sold on 30th September 2014, then sir, for the intervening period, will the SHC include the indexation benefit in a proportionate manner in the GTI? No, no, there's nothing like this. If you have purchased any asset on or after 23rd of July 2014, any immovable property, then there would not be any indexation. But any asset which has been purchased before this date, on which you can take the benefit of normal indexation, there is no proportionate concept that after 23rd of July. If you purchased before 23rd of July, then there would be a normal indexation provision. There would be no proportionate concept is there. Okay. Kasag is saying, sir, apart from immovable property, indexation is not applicable. Correct. Apart from immovable property, and that is immovable properties indexation benefit is only available to individual HUF. Remember this thing also. Okay. Sir, it COI chart is missing in the PDF you have uploaded. Yes, yes. I have actually did not complete the COI cost of acquisition chart, COA chart. I did not complete it in the last session. So today I will complete that chart in this session, we will complete a discussion on that topic. So after that, I will upload this. Okay. Chalo, moving on to our diagram. So we need to complete this chart presentation or the cost of acquisition provision from the diagram. Okay. We discussed the provision regarding right share in case of old shareholder and new shareholder both, or we just discussed about the old shareholder, existing shareholder provision? I guess we have discussed the both provision or only the existing shareholder provision. Okay. Any one of you will tell? Both. Okay. Very good. So we have discussed the provision regarding the right in case of right share, in case of old shareholder, as well as in case of new shareholder. So this part has been completed. Now we have left with other assets provision. So it's a very simple provision. If other assets have been purchased on or before 1st April 2001, the same concept is there. FMV on 1401 or purchase price, whichever is higher, would be your cost of acquisition. Okay. Ms. Divya is also on query portal. Both sir. Okay. ठीक है. And if it has been purchased on or after 1st April 2001, then the purchase price would be your cost of acquisition. These special provision I have told you that somebody asked this query, and I am saying that we will discuss this concept in detail on page number 44 of notes. That is special provision that is for cost of acquisition for long-term equity shares, equity-oriented fund, or bonus shares acquired allotted before 1st February 2018 and on which STT has been paid. So these provision we will discuss today or day after in the next class when we will discuss on page number 44. So cost of acquisition basic provision has been completed, but there are certain clarifications. There are certain special cases also in this cost of acquisition provision that we will discuss from the diagram. Oh, sorry, from the note. The diagram has been completed. I will upload this diagram. Don't worry. Moving on to the notes. Nitin is saying previous lecture में जो कराया था sir study material से भी done. Well done, very good. You should refer the study material also because everything has been given in detail. Like if you want to know what is the zero coupon bond, what is the meaning of equity oriented fund, that has been explained in the your study material. Okay. We have discussed, we have gone through with these provisions. So that was our cost of acquisition that we have discussed from the chart presentation. Detailed provisions also mentioned in the format, which we will discuss later. Now, there are some important clarification regarding the cost of acquisition and cost of improvement. Very, very interesting and very, very important for your examination. Okay. The first clarification in case of goodwill of business, etc. So that means in case of intangible asset, in relation to a capital asset being goodwill of a business, or a right to manufacture, produce any article, that means trademark, etc., the cost of improvement shall be taken to be nil. So the cost of acquisition in case of goodwill of business, goodwill of profession, or trademark will always be nil. You should not consider the cost of improvement in any of these cases. First clarification. Second is very interesting. Now suppose Mr. A purchased land in 2010 for rupees 10 lakh. And he purchased and he constructed building on this. He done construction. He completed the construction of building in 2018 and spent 20 lakh rupees on the construction. And now he sold this property on 1st May 2024 for rupees 80 lakh rupees. So in this case, you have to calculate the capital gain separately. You will be given the consideration for land separately. The question says consideration for the land was 45 lakh and the balance is for construction. So that means the balance 35 lakh is for construction part. So the sale consideration, if it has been given separately in the question, then you have to calculate the capital gain separately. Why? Because it might be possible that in case of building, land could be long-term capital asset and construction could be short-term. Because suppose if the construction has been completed in 2023, suppose, then this construction value would not get the benefit of indexation. It would be treated as short-term. So if has been treated as short-term, so the provision, the indexation would not be applicable on the value of 20 lakh rupees, as well as the tax rate would be different. So if in any question, the sale consideration of land and building has been separately given, and the purchase date of land and the construction completion date of building has been separately given, then you have to calculate those gains separately. If the value has been given in a single consolidated value, then you cannot separate it. Then you would not be able to calculate the capital gain separately. But if the information has been given separate, then you have to calculate that gain separately. So land and building non-depreciable are two separate assets for the purpose of capital gain. If land acquired before 2 year and building constructed within 2 year, then we have to calculate separate capital gain for both assets separately. Capital gain on land would be long term and building would be short term in this situation. Do not worry. In examination, separate value would be given if this kind of question has been framed. The third point says that if any asset non-depreciable acquired on loan, then interest portion of such loan till the repayment of that loan would become the cost of improvement and will be indexed if long-term capital asset. It is also very interesting information or clarification. Suppose you have purchased a building by taking a loan. The loan has been taken for 50 lakh rupees. And this building has been completed within 3 years. Till that, you have paid 10% interest on the loan of 40 lakh rupees. So the building value was 50 lakh, 40 lakh loan you have taken, and 10 lakh rupees your down payment. On this 40 lakh, you have paid 10% interest every year for next 3 years. So that means interest would be 4 lakh rupees every year. Now, after 5, 6, or 10 years, you sold this property for 140 lakh. So what will happen? Sale consideration would be 140 lakh. 50 lakh, we will do the indexation if it has been transferred before 31st of July or after, if it is an immobile property in the name of individual HUA. 50 lakh would be indexed as the cost of acquisition. But the 4 lakh rupees, whatever you have been paid for 3 years, suppose you have paid 4 lakh rupees in 2011, then 4 lakh rupees in 2012, and 4 lakh rupees in 2013. So whatever interest you have paid during that construction of house, that would be allowed as cost of improvement if that interest is not used or not allowed as income from house property deduction purpose. If interest benefit has been taken under income from house property, then this benefit could not be taken. So if that interest could not be allowed under income from house property, then any interest on loan till the repayment of loan, whatever time you have taken for the repayment of loan, the interest accrue could be allowed as cost of improvement. So you have to calculate the interest of separate years, and at the time of sale, you can claim the benefit of indexation. If you could not claim that benefit under income from house property or any deduction under section 80EE or 80EE. The interest allowed as deduction under section 24B while computing income from house property, and interest allowed under section 80EE, 80EE. Now 80EE and 80EE we will discuss under deduction chapter. But for the time being, let me tell you, these two sections also talks about the interest on loan of house property. So if interest on loan on house property benefit has been taken anywhere, then you cannot take the benefit under cost of improvement. Okay. Would not be included in the cost of acquisition or cost of improvement while calculating capital gain on transfer of house property. So it is the universal rule of income tax that you cannot claim any deduction twice. You cannot take any benefit twice. You cannot your income would not be taxable twice also. So this is a universal rule. If you have taken the benefit of any deduction anywhere else, then you cannot take the double benefit of that deduction in any other section. Okay. In case of capital asset, it's a simple old provision, so we can skip it. Any other capital asset, we have discussed that in case of any other capital asset, if it has been purchased before 1401, then the cost of acquisition would be the FMV on 1401 or purchase price, whichever is higher. But there is a clarification again where the capital asset become the property of the assessee before 1401. The provision says generally how we calculate the cost of acquisition. The cost of acquisition means the cost of acquisition of the asset to the assessee or the FMV on 1401 at the option of the assessee. So we will always take the higher, because if you will take the higher value as cost, you will have the lower taxable capital gain. Like if the property has been purchased on 1192 for 30,000, FMV was 140, so we will take the cost as 140. But there is a twist. In case of land or building or both, if that asset which has been purchased before 1401, if it is a land or building or both, that means we are talking about an immobile property. The fair market value of such assets shall not exceed the stamp duty value. So what is stamp duty value? It is the value of any immobile property decided by the government. We will know that, that is also called circle value or government value. Now the provision says we will take generally the purchase price or FMV on 1401, whichever is higher. But there is a restriction only in case of land and building or both, that the FMV could not exceed the stamp duty value. So now in case of land and building, how we will decide the cost of acquisition? That is stamp duty value or FMV on 1401, whichever is lower. That lowers need to be compared with the purchase value, and the higher would be your cost of acquisition. So your FMV cannot exceed the stamp duty value. So if FMV is, suppose the question has been given over here, you can see that. If in the above example, in which the FMV was 140, suppose the stamp duty value would have been 1,20,000 as on 1401. Then we will take the value as purchase price 30,000. Or now we will take 120, because from 140 or 120, we will take the lower value. So now the cost of acquisition would be 1,20,000, not 1,40,000. So please keep this also in mind, that in case of land and building, the FMV could not exceed the stamp duty value, or we can say that we will take the FMV or stamp duty value, whichever is lower. If in the question stamp duty value is not given, then do not bother about it. Take that FMV for the purpose of comparison directly. So can indexation available in both tax regime? Yes, indexation on long-term assets is available. Both tax regime, that is regarding that amendment of 23rd of July. That is also applicable. What is meant by fair market value? The market value on which that property should be purchased or sold. And stamp duty value is government value. So that could be different. If you're living in a house, the market value on which you can sell it, that would be different. And the government value, which has been decided by the government, that would be definitely different. So these are both different values. That would be given in question. Do not bother about it. Cost of acquisition for goodwill, etc. We have discussed those provision. Now the detail has been given. So if you want to see the details, that in which case we have applied as per the diagram, which cost of acquisition, that you can take from over here, except this point, because this point we will discuss later on page number 44. This is the 31st March 2018. These provision we will discuss on page number 44 of the notes. So except these detailed provision, you could understand all the provision from this table and you can compare it with your chart. So that we have already discussed under our diagram and chart presentation. Now, we are moving on to some special and specific provision. Now the section 47 is over here. And section 47 talks about cases in which transfer is not regarded as transfer. And you might remember that I just discussed a simple example regarding this section 47 in the definition of transfer. When we were discussing definition of transfer under section 247, then I have told you a simple example which was connected for section 47, and we have discussed about this also. So, any one of you remember that what we have discussed about section 47 in the definition of transfer under section 247, regarding which point we have discussed this section 47? Whether he's saying relinquishment, absolutely correct. Riddhi is saying sale. No, Riddhi, not for sale. We have discussed it for relinquishment gift provision. Like I've told you that in case of gift, will, or transfer, donation, that all are the example of relinquishment. So extinguishment is not the correct answer. Relinquishment, in the case of relinquishment, we have discussed. I have told you that in case of relinquishment, when there is a gift or donation, etc., so there would always be a loss. So income tax says yes, we have include the definition in the definition of transfer, the definition of gift, etc. But that will always result in case of loss. So I have told you कि अभी तो section 247 में they are considering gift as transfer. But later in the section 47, they will exempt this. They will not going to taxed, or they will not going to include these transaction under the definition of capital gain, because in that case government will always lose revenue, because there will always be losses, and those losses could be set off from the other income. Clear? So exactly section 47 cover point number 2 regarding that point what we have discussed under section 247. So cases in which there is transfer, of course, that was a transfer. Like gift is a transfer. So they are saying cases in which transfer is not regarded as transfer. So there is transfer as per section 247, but we have specifically excluded those transfer from the definition of transfer. So these are, we can say, these are technically exempted capital gain. Not technically, practically we can say that these are exempted capital gain. So these are the transaction which has been included under the definition of transfer, whether they are relinquishment or they are sale or they are exchange or they are extinguishment, etc., etc. So they are technically the transfer definitions. But we have excludedly, even after they are included in the definition of transfer, but we will not charge capital gain. Why? Because in almost all these cases, government would not have any revenue. So they have technically exempted all these transfer from the chargeability case. Understood? So one by one, we have to discuss these provisions. There are almost 15 transactions, 15, 1 5, in which transfer would not be regarded as transfer. Clear? So distribution of asset at the time of partition of HUF. So under section 171, I guess, there are partition, that is partial partition or total partition of HUF. So during that partition, if any asset from HUF is going to transfer to any of the member of the family, that is outside the purview of chargeability. Because again, that same case, okay, partition of HUF in which we going to transfer asset of HUF to the member of HUF. So technically, what is this? This is kind of a kind of a gift, a kind of a relinquishment, because HUF would not charge anything. So they will transfer it without consideration. So suppose if HUF transfer any asset to the member of the family without consideration, so what would be the sale consideration? Zero. Cost would be there, so there would be always loss. So department say hatao, hatao, hatao. No taxability. Hatao is a definition, say exemption में डाल दो. So the partition of HUF के time पर, if any distribution of asset took place, that is outside the purview of chargeability. Clear? Logic is the same. There would always be loss. Now there is point number 2, which is having some amendment also. Transfer of capital asset under a will, gift or irrevocable trust. That is again relinquishment. that if you transfer your asset as a gift or as a will or as an irrevocable trust, then there would be no transfer. So this is as per assessment year 24-25. But now this has been changed. There's an amendment in this provision. Now these gifts are only exempted for individual and HUA. Earlier, this benefit is for all person. Anyone can transfer any asset as a gift, will, or irrevocable trust. That means donation to anyone. And there was no capital gain. But now the amendment has been from the assessment year 25-26, which has been discussed in the below provisions. Now this is new provision. This is now the benefit is only available to individual HUF. So this is for assessment year 25-26. Any transfer of capital asset by an individual or HUF. Now you can see the difference. That was not any individual HUF was mentioned. This benefit is for all person. But now the benefit is only for individual HUF. So if individual HUF transfer any asset to anyone as a gift, will, or irrevocable trust, there will be exempted capital gain. You can see the note up to assessment year 24-25. Transfer of a capital asset other than shares, debenture, warrants allotted by company under ESOP, under a gift or will or irrevocable trust by any person was non-taxable. So up to 24-25, the gift, will, or irrevocable trust was non-taxable if it has been given by any person. But from this assessment year, that is assessment year 25-26, which is applicable for May 2025 onwards, in this case, only exemption is available to individual or HUF. So what was the provision, what the change has been done? Like till assessment year 24-25, gift, will, or donation by any person is exempted. Only if company provides ESOP, etc. to its employee as a gift, that is taxable. So it was also taxable. This point has been taxable even in assessment year 24-25. So if a company gives anything under ESOP, etc., to its employee, etc., in that case, that was not exempted. That kind of gift was taxable earlier also. Now assessment year 25-26, by individual HUF, gifts are exempted. So this ESOP was earlier taxable, exactly now also taxable, and all other kinds of gift by any other person also taxable. So earlier this provisions is also same, that was also taxable in last year also, in this year also. But just one change has been done, that any transfer by individual HUF, that is only exempted from assessment year 25-26. So that has been also explained there. So you can see there was old provision also mentioned to clarify you the provision that was in earlier year, these consideration of shares, debenture, warrants issued under ESOP in case of transfer under a gift, etc. up to assessment year 24-25. So let me make it very easy for you. Why to bother about all these old provision? That is none of your business. Why? Let me make easy for you. You can remember all these provision like this now. Because ESOP could not be provided by individual HUF, that would be provided by a company. So for assessment year 25-26, if I am going to make it very easy for you, this provision that any gift or will or by donation. Now the provision is so simple. By individual HUF is exempted. Or we can say that is transfer, not regarded as transfer. Other all cases, whether it's ESOP, etc., that is going to be taxable capital gain. So you can remember for assessment year 25-26. Why we need to understand that what was the provision till assessment year 24-25. That is for not, that is just a clarification that has been given you the study material. But in my opinion, that is not required. Because from now onwards, it's very easy that gift, if has been transferred by individual HUF, that is exempted. Any other kind of gift, etc., is going to be or chargeable to capital gain. I hope it's clear. So now this benefit is only available to HUF. Earlier it was for all person. Now the case of amalgamation. Transfer in case of amalgamation by an amalgamating company to amalgamated company, provided the amalgamated company is Indian company. So you must have known all this thing, that what is the meaning of amalgamation, etc. So if there is any amalgamation of two companies, then in case of that process, the assets of amalgamating company technically transfer to the amalgamated company. So that is also a kind of a exchange, or that is also a kind of a transfer of asset from the ownership of amalgamating company to the amalgamated company. So that kind of transfer of asset is also being exempted from the definition of transfer to making it tax neutral. Because in case of amalgamation, all the asset must be transferred, all the liability must be transferred, should be at book value, and the shareholding of at least 75% should be the same. In case of accounting, the requirement is 90%. In case of income tax, amalgamations requirement is 75% of shareholding should be the same. So if these conditions fulfill, and if the amalgamated company is an Indian company, so if any asset has been transferred from amalgamating company to amalgamated company, then this transfer is also exempt from tax to make it tax neutral, because technically asset is not transfer. The intention is not to transfer the asset. The intention is to transfer the business. Suppose there is A Limited, and A Limited is not able to continue its business. The management problem or any other problem, the marketing team is very poor, the production problem, anything, the quality of product, etc. So now that A Limited is having two options: either they can sell this business, or they can sell these assets, or it is an option that any other company in that industry like B Limited is also there. And if B Limited wants, B Limited can acquire this A Limited in the form of amalgamation. So what will be the benefit if the company has been shut down by selling of its assets separately? So there would be unemployment. So government is encouraging amalgamation, because if you are not shutting down your company and any other company is ready to purchase your whole business, they are not purchasing your asset, they are purchasing your full assets, full liabilities at book value, and including the shareholding pattern also. So due to amalgamation, there would be employment, because company is not going to shut down. It is now going to be organized and run by B Limited. So income tax department encourage amalgamation because it is the benefit of employment, revenue collection, etc. So making it tax neutral. Tax neutral means that we are just trying to neutralize the tax. That this is not the case of transferring of asset. Technically, it is the case of transferring of business. Now, A Limited would not run this business in behalf of A Limited. B Limited will run this business. So there might be possibilities of future employment, growth, revenue collection, tax collection will increase. So that's why there are two concepts like amalgamation and demerger. In both cases would be tax neutral, because in that case, there is the benefit of employment in our country. So in case of amalgamation, all the asset transfer from amalgamating company to the amalgamated company would be outside the purview of capital gain chargeability, provided the new company should be an Indian company. The B Limited would be called amalgamated company. A Limited would be called amalgamating, and the company which is going to run this business in future, in this example, might be B Limited. So B Limited should be an Indian company for taking the benefit of this exempted capital gain. I hope it's clear. Amalgamation cannot be done by any other than company, Sai Kiran Kumar. What kind of question is this? Individual cannot amalgamate. Amalgamation concept is only for company applicability. Okay. You might be asking that in case of amalgamation, only assets are exempted, but whatever shareholder will transfer their share also in case of amalgamation because A Limited is going to shut down and its shareholder now they will get in exchange the shares of A Limited they were holding. Now they will get the share of B Limited in exchange of shares of A Limited. So because they will get the share of B Limited, so that is called exchange. That is also tax neutral in the next point that we will discuss. No, amalgamating company could be a foreign company, Larry, but amalgamated should be an Indian company for taking this advantage. If A Limited is a foreign company, not an issue, there would be tax advantage. But we need that the new company should be Indian company, the amalgamated. Okay. Of course, that in case of amalgamation, we have seen there would be two kinds of transfer. Suppose there is A Limited and B Limited. So in case of amalgamation, one, the asset is going to be transferred. So that would not be treated as capital gain. That would be outside the chargeability of capital gain if this is your Indian company. Clear? That was our point number, I guess, 3 we discussed. Now point number 4 says, in case of amalgamation, what will happen? Suppose there are shareholder like Mr. E, F, G, H. Those are having shares of A Limited. Now A Limited business has been acquired by B Limited. So the shareholders of A Limited will now get the shares of B Limited. Now they will get the shares of B Limited in exchange of shares of A Limited. So that is called exchange. Exchange also include in the definition of transfer. But we do not make the amalgamation to tax. We just need to make this amalgamation process tax neutral because it is for the benefit of country. So this exchange has also been exempted having two conditions. First is the same that the new company, the B Limited should be Indian company, but there is one more requirement, one additional requirement to make this exchange exempted. And the requirement is that only shares will be allotted in against share in exchange. So in case of A Limited share, in against A Limited shares, we will only provide the shares, no cash, no other kind of monetary payment, no other kind of any asset would be provided. Only shares will be provided in exchange of shares. If there any other payment involved except shares, then capital gain would be charged. Suppose there is a concept that in case of two shares of A Limited, you will get the one share of B Limited. So suppose Mr. H is having 1000 shares of A Limited. So in this amalgamation, now he will get 500 shares of B Limited. So this exchange would be exempted if only shares will be provided against A Limited shares. Suppose in this case, 400 shares allotted and 100 shares monetary value has been paid by check. So in this case, this capital gain is going to be taxable. Understood? But suppose the case is like this. We having 1000 share and the ratio has been decided 3:1. Now against 3 shares of A Limited, you will get only 1 share of B Limited. So now the conversion would be 333.33. Now how it's possible to take shares only? Because for this portion, you can take the shares. But 0.33 part, you cannot take the share. So this is a genuine problem. So in this part, you can take the money that is allowable. So the provision says only shares will be allotted against shares. But in case of fraction of shares, monetary payment is allowed. So capital gain would be still exempted. But if there is no fraction of share cases, then there cannot be any other consideration. So the same provision we are discussing in amalgamation, Same condition that going to be discussed in demerger also. Exactly same provision. In case of demerger also, assets exempted and shares also exempted if these condition has been fulfilled. Everything has been written over here. You can see any transfer of shareholder in the scheme of amalgamation of the shares held by him in the amalgamating company, provided amalgamated company is an Indian company and transfer is made in consideration of allotment of shares in the amalgamated company, no part of consideration will be other than shares. Consideration other than share is allowed only in case of fraction of shares. Clear? Well done. Exception, the exemption mentioned in 3 and 4 above will not apply if it is a capital asset is transferred as stock in trade. So of course, we are discussing the provisions of capital gain. If it is not a capital asset, then the exemption would not be there. If the stock has been transferred, then PGBP concept will be applicable. We are only discussing about those capital assets, those have been transferred during that amalgamation. The example also, M held 2000 share in company ABC Limited. This company amalgamated with another company during the previous year ending on 31st March 25. Under the scheme of amalgamation, M was allotted 1000 share in the new company. The market value of shares allotted is higher by 50,000 than the value of holding of ABC Limited. So assessing officer wants to tax this transaction. So can he do so? The solution say no. If the amalgamated company is Indian company, then this transaction is outside the purview of chargeability. Okay. Now another case of companies. Now this case is regarding holding in subsidiary. So if any capital asset has been transferred from holding to subsidiary or subsidiary to holding, there would be no capital gain, provided the transferee company should be an Indian company and the entire share capital of subsidiary should be held by the holding company. Now, suppose there is a company which is H Limited and there is a company S Limited. And of course, this is holding company and this is subsidiary. Fine. Now the provision says if any holding company transfer his asset to its subsidiary, any capital asset, or vice versa, if subsidiary transfer its capital asset to its holding company, then there would be no capital gain if two conditions fulfill. First one is transferee company is Indian company. And second, that holding company holds entire share capital of subsidiary company, entire share capital of subsidiary company. Like we all know how much shareholding we need to make any company our subsidiary. Nitin is saying 15% or more, correct? So generally, we can make any other company our subsidiary if we are having 15% or more of the share capital voting power of that company. Clear? Now I have two questions from all of you in this scenario. So when I'm saying that the transferee company should be an Indian company, so about which company we are talking? H Limited or S Limited? Which company should be Indian company in the above example? H Limited or S Limited to fulfill condition number 1? Hardik is saying H Limited, Anirudh is saying S Limited, Bhumika is saying S, Manvi H, Nitin H, Aisha H. Lahari is actually answering correct. You are not reading the provision. Kasik is also correctly answered that question. There is no answer of this question. The question said transferee company should be an Indian company. Transferee. Transferee means who is receiving that asset. So if the asset has been transferred by S Limited to H, in that case, H Limited should be Indian company. So it will depend upon the case. Who is transferee? Do not answer that only S Limited, H Limited. That is a wrong answer. If holding transferring asset to S Limited, then S Limited should be an Indian company. So I did not told you who is transferring asset. I am just asked you that in this case, which would be Indian company, and you are just answering without even thinking what the question I asked, without even thinking what is the provision is there. Provision does not mention that H should be or S should be Indian company. The provision says transferee company should be Indian company. So when I asked whether it should be H or S, so you should say like this: if H Limited is transferee, then H Limited should be Indian, and if S Limited is transferee, then S should be Indian company. That's what I'm trying to say. Kindly listen to the problem. I might be also discuss this thing in the first session of basic concept or residential. There is a process to give answer. We have three process to give answer of any question. First of all, listen the problem, or that means understand the problem, or that means read the problem. Then brain, apply the provision, think about the question, and then link it to the provision what you have learned about that, and then answer or write the answer. Either say or either write. So in your personal life or your professional life, these process need to be followed always. Understand the problem or listen that, then process it with your brain or with the provision. Then answer. You are doing what? You are listening and just speaking answer. So that is wrong. Understand? Understand the question. Okay, chalo, moving on. Now, second question is entire share capital we need. Only in that case, this kind of exemption would be there. So if I am having only 70% share capital, still S Limited would be my subsidiary. But this capital asset exemption you cannot claim whether holding transferred to subsidiary or subsidiary transferring to holding. So for the purpose of getting the benefit of this exemption, we need 100% shareholding of S Limited. Now, when there is word entire share capital, what does it mean? Only equity or preference or both? What kind of entire share capital we need? What is the meaning of entire share capital? Either we are only talking about equity shares or we are talking about equity and preference both. For the purpose of making any company our subsidiary, what kind of capital we should have? Equity or preference? For making our subsidiary. To become a holding of any company, what kind of shareholding I should have? Equity. So what should be the meaning of entire share capital over here? Only equity 100% I need, or equity as well as preference 100% we need to get the benefit of exemption? We need entire share capital. So what is the exact meaning of it? Entire means both, not equity only, Shruti. We need both equity as well as preference shareholders. So we should have full 100% share capital of S Limited in our hand. Only in that case, if you are transferring your asset, if you are receiving the asset, that capital gain would be exempted if transferring company is an Indian company. Okay. So moving on to the provisions, has been mentioned over here. So any transfer of capital asset by holding to its subsidiary or vice versa, provided transfer is an Indian company and holding holds entire share capital. Next is very simple. Any transfer of a capital asset, being any work of art, archaeological, scientific, or any collection, book, manuscript, drawings, painting, photograph, print, to the government university, national museum, national art gallery, etc. So if you are having any antique things and if you transfer these things to government museum, etc., there would be no capital gain. Clear? Any transfer of FCCB. FCCB is foreign currency convertible bond. So we generally know what is the meaning of convertible bonds, convertible debentures. So if we issue convertible debentures or bond which would be convert into the share in future, that we call convertible debentures or convertible bonds. So if we are issuing these convertible bonds outside India in foreign currency, we called it normally foreign currency convertible bond. So there is no difference. So if you are issuing normally convertible bonds in India in Indian currency, that is normally convertible bonds or debenture. If you are issuing them outside India in foreign country in foreign currency, we called it foreign currency convertible bond. Clear? Then ADR is American Depository Receipt. So if you issue shares in India, we called it IPO, FPO, etc., or we called it normally equity share, etc. If you issue shares outside India against those equity share, we issue another security that is called ADR. So if we issue ADR against equity shares in America, that is called American Depository Receipt. So we can understand it in layman language. If you issue equity shares outside India, that is called American Depository Receipt. We do not have any voting rights on ADR. The difference between a normal equity share and ADR is ADR does not have any voting rights. So the investor would not have any voting right. They will have the benefit of dividend, bonus share, etc., but they will not get the benefit of voting. And GDR, if it is issued any other place except America, that would be called GDR, Global Depository Receipt. So if your equity share is issued in foreign currency outside India, that is generally called ADR. Technically, we do not issue equity shares. So equity shares would be remain in India. But against those equity share, against on that security of equity share, we issue depository receipt. So if these depository receipt is issued in America, that is called ADR. Other than America, GDR. Okay. Or again, we have now right to issue rupee denomination bond also. So if you are issuing rupee denomination bond also outside India, now what is the benefit? The benefit says if FCCB, ADR, GDR, suppose any Indian company A Limited issued FCCB and suppose they issue in America. ठीक है उधर का इन्वेस्टर है सपोज द इन्वेस्टर इज मिस्टर बी who purchased these FCCB. He's a non-resident. He purchased these FCCB, ADR, GDR, or rupee denomination bond in America. He purchased it. And after some time, he transferred that bond to someone else in America who is also a non-resident. So there is a transfer of ADR, GDR, FCCB, or rupee denomination bond outside India. So transfer should take place outside India by a non-resident to another non-resident. Then there would not be any capital gain chargeability. So condition, remember, these all should be securities which has been issued outside India. FCCB, ADR, GDR, we also call them Euro issue or rupee denomination bond. So, and if that has been issued outside India, now the buyer and seller buy one non-resident to another non-resident. And if that transaction has been taken place outside India, then there would not be any capital gain chargeability. The problem is that in that case, you cannot recover it. Practically, the income tax department cannot recover it, I guess. That's why it has been exempted because the buyer, the seller, the place, all are outside India. So it would be really difficult to recover that tax. So that might be exempted or to encourage the purchase of these bonds. That might be also the intention. So for this exemption. Next is the demerger concept. We have discussed exactly same copy paste provision like amalgamation. Any transfer of capital asset by a demerged company to resulting company during demerger is exempt provided resulting company is an Indian company. So the company receiving the asset should be a Indian company for the benefit. In case of amalgamation, there are share transfer also. Exactly same concept of share transfer is here. In case of demerger also, shares transferred from one organization to another. And for get the benefit of that share conversion exemption, the resulting company should be Indian and only share should be transferred only in the form of shares. No other consideration. And the consideration other is allowed only in case of fraction of share. So copy paste provision in case of amalgamation and demerger. Now again, the same kind of provision which have been discussed like FCCB, etc. Any transfer of capital asset being a government security by one non-resident to another non-resident outside India. So FCCB, ADR, GDR was private companies securities which has been issued outside India. So even if government issue any security outside India and that has been transferred by one non-resident to another non-resident and the outside India, then again that is not chargeable to tax. Next is any redemption of sovereign gold bonds under the government scheme by an individual would be exempted. There is some gold bond which was not capital asset under section 214. So those who are not capital asset does not need any exemption. They are already outside the purview of capital gain. These sovereign gold bonds are capital asset, but they have been exempted from the chargeability. If it has been by an individual, remember, the difference is also by an individual, then exempted. Then conversion of gold into electronic gold receipt or vice versa. Any transfer of a capital asset being conversion of gold into electronic gold receipt issued by a vault manager or conversion of electronic gold receipt into gold. That is a government scheme. There's no capital gain on conversion and reconversion. So if you have the gold, electronic gold receipt and you convert it into gold, or if you convert your gold into electronic gold receipt, in both cases, these are exempted and these are outside the purview of chargeability. Now the clarification, we have discussed almost 12 provision above. You can understand we have discussed the provisions of HUF partition, then individual HUF gift provision we have discussed, then two provisions of amalgamation, then one of holding subsidiary, then one of government ko museum etc. ko we are transferring antique. Then we have demerger, two provision of demerger. Then we have two provisions for securities outside India, either by ADR, GDR or by government department if the security has been transferred by one non-resident to another non-resident outside India. And then we have sovereign bonds, one provision, and one is gold, and this conversion concept is over here. So in these cases, in all these cases, these are exempted capital gain. Now, very interesting question for all of you. So these are all exempted capital gains. So what is the probability that in the examination, you will get a question for these transactions as a numerical or a theoretical provision? What we should expect out of these capital gain? That might be theoretical provision should be asked out of these provisions, or there could be numerical provisions, more probability out of these 12 cases in which there are no capital gain taxability. That means if there is a question like A Limited has transferred asset to B Limited and B Limited is an Indian company, calculate capital gain. So what we should write? We should write exempted capital gain. Transfer not regarded as transfer capital gain. So what is the probability of these cases? The provision says if you look like on the basis of the concept, it would more like theoretical. That might be they are going to ask you in examination, explain 5 exempted cases, exempted conditions, etc. But generally or practically what is going to be happen, the practical question is going to be asked out of these transactions always, almost always there would be chances to frame practical question in these 12 cases and remaining 3 also. How and why there would be practical questions? So that is a very interesting case. Let me tell you why there could be chances for a practical question more in these 12 cases. There is a very strong reason for it. What will happen? The question would be like this. And we are having almost 15 exempted capital gain and we have discussed only 12. Remaining are 3. So why we have separated those 3, we did not discuss those 3 also because the tax treatment or the calculation of these 12s are same. And the calculation of these three practical questions is different. So we are discussing how to solve these kind of 12 questions. So even if there is a question of partition of HUF or gift or amalgamation or demerger or holding subsidiary, etc., etc. So all these 12 cases, any of these 12 cases, if it has been a practical question in the examination, the solution is same. So that's why we are understanding these 12 provisions separately, and these three exempted capital gain, what we will discuss later, the solution procedure is different. So that's why we are not discussing that three cases right now. First of all, we are trying to understand the solution pattern of these 12 cases. Understand? So whether the question belongs to gift or partition of HUF or amalgamation or demerger does not matter. The solution pattern would be same in all these cases. So why there would be numerical case? First of all, let me tell you this. The question will not be like this. The question would be like this. Suppose there is Mr. A. He was having a property of 10 lakh rupees. He gift this property to his brother. Suppose in 2015. At this time, the fair market value was suppose 50 lakh. He purchased this property in 2010, suppose. So because it is gift, so that means section 47 will applicable, and it will say there would be no capital gain in 2015. So of course, this kind of practical question would not be an examination, because in a minute you will answer that this is not applicable or exempted, so there would not be any capital gain. But the question is not going to be end over here. The question will run further. Now the brother transfer this building via will to his son. Suppose in 2021. At that time, the FMV was suppose 80 lakh. Again, will also be under section 47. So it will not affect anything. Now, these both are exempted. So we will not do anything in 2015 and 2021 because these are exempted capital gain. Now the son sold this asset, suppose, for rupees 110 lakh rupees in 2024. Suppose 10th May 2024. Now the provision would be applicable for the chargeability of capital gain, because now this transaction is the transfer which is going to be taxable transfer. So now we need to solve this kind of question. So in all 12 cases, whenever they will be in question, the question will not end at that point. The question will go further till that point when there would be a transaction which is going to be taxable. Now, what is the concept or how we need to solve it? That we will discuss in another example. First, I was just trying to explain you that why the numerical question is going to be framed out of these 12 transactions, because always the transaction would go further till the time this asset has been going to be a transfer which is going to be taxable. Now, the problem arises in these kind of question is this. The heading for starting a question under income tax is always there should be this kind of heading which says computation of, whether you are solving a question of residential status, whether you are solving a house property question, whether you are solving a salary question or PGBP, etc. So we have to follow this heading in each and every question. Computation of capital gain in the hands of assessee. We always need over assessee. So who is assessee in this case? Who is the assessee in this case? The assessee means the person who get the money, the real money. So when A gifts to B, is A received something? No. When B transferred to its son, is there anything he received? No. So the son technically received the money. So he will going to pay the tax. So that would be the assessee. So the son would be the assessee. We will write down the name. In the question, there would be some name. So we will write down that name. Computation of capital gain in the hands of son for, we need to write down the assessment year. Assessment year 2025-26. So the first step to solve any numerical or any practical question under income tax, Always remember, you have to write it down. If you are calculating salary, we will write it down. Calculation of salary income in the hands of so and so for assessment year so and so. Either it's house property, etc. Clear? Now, after writing this, the second point, which is very, very important. Suppose the son name is A. Okay? So assessee is A. Clear? So the computation of capital gain in the hands of assessee, that is Mr. A, for assessment year 2026. The second important point in case of capital gain is period of holding. You have to show that in your question solution. Period of holding. Period of holding means whether this asset should be a long-term asset or it should be a short-term capital asset. So now the problem arises. If you will see the period of holding of Mr. A is from 2021 till 2024. If you see from the point of view of assessee, the provision, layman provision, whatever we have discussed till now, would be around 2, 3, 4, almost 3 years. So that would be a long-term capital gain. But now the twist comes. That's why these 12 cases are so important for your examination. The provision says if anyone received asset from those transactions, those does not fall in the definition of transfer. Then the period of holding will be taken from the date the previous owner hold that asset. So who was the previous owner? Brother was previous owner. So might be the period of holding could be 2015 to 2024, but there is again a problem. Mr. B also was not paid anything for that asset. He received this asset also from a exempted capital gain concept. So the period of holding would be taken from that person who technically paid for that asset. That is Mr. A. He would be called previous owner. So the provision says in case of transfer, those are exempted from capital gain. Suppose these are nil. There is no transaction of B. So the transaction would be treated as between A and, sorry, the son name was A and this is also A. So we change the son name like C. C is the son name, okay? Because that is Mr. A. So the assessee is C in this case. And the person who received these asset due to section 47 cases. So that time period would not be considered. The time period would be considered from that person who has actually purchased that asset other than any mode that is for under section 47. So that person would be called previous owner. So the period of holding of this asset, technically you can assume that this all information says irrelevant till now for the purpose of period of holding. So always remember, if these are transaction which has been exempted under section 47, that situation we need to take the period of holding from the period of holding of previous owner. That means we will assume that asset has been purchased by A and sold to Mr. D. Suppose this is D. So the period of holding will be from 2010 till 2024. So that would be long-term capital asset. So if there is any transaction which is covered under section 47, so that duration will not be considered, or we can say that duration will be included. That would be included for the purpose of period of holding. So because the son received from that section 47, so this time also include in the period of holding of asset. Again, the brother who received, he's also received section 47 benefit. So that time period will also include. So from that time period that Mr. A has purchased that asset by other mode that has not been included in section 47, from that time duration, we need to take the period of holding. So that would be from 2010 till 2014. First clarification, for all these 12 cases, these provision would be applicable same. Now the third case. After period of holding, we need the sales consideration for the purpose of solution. So the sales consideration has been given in question 110 lakh rupees. Clear? Now the problem is if that is long-term capital asset and it has been transferred before 23rd of July. So we are going to apply the indexation concept. For the purpose of index cost of acquisition, first of all, we have to find the cost of acquisition. Again, the provision says the son who received that asset as a will does not pay anything for it. So that has been excluded. The cost of acquisition also will be taken from the point of view of previous owner. So who was the previous owner? Mr. A. So now cost of acquisition of Mr. A would be considered because B and C did not pay anything. So the time period and the cost would be taken from the point of view of previous owner in these 12 cases. Remember always. So whatever Mr. A has been paid, that would be considered as cost of acquisition. Now a very interesting thing is about to come and I will ask that. Now for applying this indexation provision, the index for the upper part should be the transfer year index. The transfer year index as per the formula. So what is the transfer year? Our year, because the other 2 years were not a transfer. So the index of the transfer year would be 363. Now the main concept comes over here. Ambeshwari is asking when Mr. A going died, what to do? A is transferred his asset in this case to Mr. B. So this is not the question. I don't know what you exactly wants to ask. Okay. Now, as per the formula, if you'll see, whatever has been written in the provision, that's why I've marked that portion again and again. If you'll go to the formula of indexation, the formula says in the lower part that index of the year in which asset is held by assessee. Asset is held by assessee should be taken. Remember, that has been written, the asset held by assessee. So who is the assessee in this question? So here was the formula. And you can see the formula says for the purpose of index cost of acquisition, the formula is having says asset is first held by assessee or 2001 index, whichever is later. Clear? Held by assessee. Now there is a very interesting thing. We have to apply according to the act, obviously. So if I'll ask you who is the assessee in this question, so we need the index of assessee or 1401. That 1401 would not applicable in this case because asset is held initially in 2010. Fine. So later would be only the assessee index. So who is the assessee? Let me see who is the assessee according to you, the son, or we can say Mr. C. So technically, assessee is Mr. C. So that's why very important to write assessee in the question of capital gain always. You have to write it down the assessee name over here because that's why you're not going to confused because we need assessee index and assessee hold this asset. Assessee received that asset in which year? In 2021 he received. Clear? So because if he received that asset in 2021-22 financial year, we are assuming, so that was the index for that year was 317. So accordingly, the index was 317. That is how the assessee received that asset. So if we solved it in that situation, 10 into 363 divided by 317. So the index cost of acquisition would be around 11.45 lakh. And the capital gain would result in 98.55 long-term capital gain. Clear? As per the act, this is going to be happen. But there is a problem. The assessee says again that this is unjustified. This is wrong. So why? Because assessee says when there was requirement to calculate the period of holding, then you took the indexation from Mr. A point of view, the time period of holding. You took the period of holding from the point of view of previous owner, that is from Mr. A till 2024. when there was the period of holding concept was there. When there was cost of acquisition concept was there, then we took the cost of mystery. So we are taking period of holding as per mystery. We are taking cost as per mystery. Then why you are taking index as per SSC and not as per Mr. A? Because this 10 lakh belongs to Mr. A cost of acquisition. Then how can we take the index of this SSC? Mr. C index could not be used over here. So this litigation has been gone further. And in the case of Manjula J. Shah, you have to remember this case. Manjula J. Shah, department accept the contention of assessee that yes, because we are taking everything as per Mr. A, then now we will take the index also as per Mr. A. Everything else will remain the same. Assessee would be C. There is no change. He will remain the same. Period of holding, of course, would be from the point of view of Mr. A, that is was 10/2024. Nothing would be changed, but we have to recalculate the gain also. And that sale consideration would be same. The index cost of acquisition, only that index need to be changed. The 10 into 363. And now we need to take the index as per Mr. A. That was 2010 index we need to take. And 2010-11 index is 167. So now index would also be according to Mr. A. That is, index is also from previous owner case. You are taking period of holding as per previous owner. You are taking cost as per previous owner. Then you need to take the index also. And that would result, the gain would be lower now, because now my cost index cost of acquisition would be around 21.74 lakh. And due to this, my capital gain would be now 82.26. So now you can see there's a difference in the capital gain. So this is for the benefit of assessee. Now the problem remains is this: the act does not change the formula yet. In the act, it has been specifically stated till now that the index of the assessee should be taken. So act is saying we need to take the 317 index. And this case law judgment is saying we need to take the previous owner index. So for the benefit of assessee, this need to be followed. But act does not change it yet. So what we need to do in examination? So there's a bad news for you. You have to solve it by both methods. And it is not that difficult, because you can see I do not need to change anything except this one thing. This index just need to be changed. In respect, instead of 317, I just need to take the previous owner index. That's it. Everything else would be exactly the same, copy paste. So there would be like 2 minutes. You need to give more for the solution, because you have to write it down again, the assessee, the period of holding, the sale consideration, etc. But there is no extra calculation, except you just need to change that index that need to be replaced by previous owner index. So if in question it has been said that you have to calculate as per Manjula J. Shah, then you need not to calculate as per the act. But if the question is silence, then you have to show the calculation for as per both method. And because we need to take always those method in consideration which is most beneficial to assessee, so we will take this capital gain for the purpose of tax calculation. Understood? I hope yes. And this question has been asked in May 2024, I guess, examination. Okay. Hardik is saying, sir, in case of cost of improvement also, we have to take assessee holding and Manjula Shah will take the previous owner holding. No, you forgot the formula for cost of improvement. In case of cost of improvement, in the lower side, in the second part, for the purpose of dividation, we do not use assessee index. We use the index for the year in which improvement took place. So in case of cost of improvement, there is no confusion. You need to take only the index of that year in which improvement took place. assessee is irrelevant in this case. So this problem will not come in case of cost of improvement. We will solve that kind of question. Do not worry today. I have changed the sale consideration. Okay, yes, you're right. Mistake हो गया मुझसे. I have written down 100. That should be 110. So it will remain 110 minus 21.74. So this would be 88.26. Correct. My mistake. Clear. Fine. First by act, second by case law. Yes, you have to done this. So that was all 12 cases need to be solved like this. We have three specific provision that period of holding would be taken from the previous owner. The cost of acquisition would be taken from the previous owner, and the index should be used of the previous owner also. Clear? So moving on to the provision now again. Okay, so these are the clarification. In all above cases, capital gain will be exempted as transaction will not regarded as transfer, but in above cases when assessee will transfer these assets, in normal case, in that year, capital gain will be liable to charge as follows. We have given the example of course. Suppose Mr. Previous owner is Mr. A, purchased in 2012 for rupees 10 lakh. Gifted to Mr. B in 2016. B sold it to C for January 2024. Let's change this to June 2024. That would be my previous year, 24-25. Assessment year, 25-26. Okay. So now, suppose B sold to C. So now assessee would be the B because he is getting the money from Mr. C, that is 32 lakh rupees. So he would be called the assessee and A would be called previous owner. Now, how it's going to be solved? If I'll ask you, then the period of holding in this case would be from 2012 because we need to take from Mr. A till 2024. Cost also would be taken from the point of view of Mr. A, that is 10 lakh rupees. The index would be as per the act should be as per Mr. B, that is 2016 index. But as per Manjula Desha, we need to take index of 2012. Everything has been written. For Mr. B, capital gain period of holding will also include period of holding of the previous owner, that is from 2012 to 2024. Cost of acquisition would be 10 lakh rupees as cost to previous owner. Index for normal case of Mr. B, assessee will be taken. In case of Manjula Desha, index of Mr. A need to be taken instead of Mr. B. Again, the provision has been clarified. In case of our transaction, cost would be taken from previous owner cost of acquisition. So cost would be old cost of acquisition. Old cost of acquisition means whatever has been in the hands of previous owner. Period of holding would be old period of holding. That means the previous owner period of holding should also be considered. Index would be applicable new index, that was assessee index as per act. Now Manjula Desha, CIT was Manjula Desha, Bombay High Court 2011 judgment. It says cost would be previous owner, holding would be as previous owner, and index also would be from previous owner should be there. Now point number 13 is for reverse mortgage scheme. And what we will do, now we will take a short break because almost 1.5 hours we have completed. Let me see if there is any query. So in case of shares, also Manjula Desha will also apply. Look, in case of shares, we do not need to apply Manjula Desha because there is no change of assessee. Suppose I am having shares of A Limited. Clear? Now A Limited is amalgamated with B Limited. Clear? So now B Limited will give shares in exchange of shares of A Limited. Now B will give me the shares of B Limited. So I will still be the same. Assessee will not change. Yes, period of holding would be counted from when I have purchased the share of A Limited. cost of whatever shares I have purchased or I have paid for a limited share, that would be considered. But automatically, in case of holding subsidiary, in case of demerger, in case of amalgamation, this Manjula Jisha would not applicable because assessee does not change. I would be the same assessee whether amalgamation take place or not. So if you apply that case, you will find it out that assessee consent would not be applicable in this case automatically. If assessee change in these 12 transactions, then previous owner cost, holding, and index would be taken as per Manjula J. Shah. Okay. Any? Okay. No more query right now. So we are going for a small break. Kindly have your tea, coffee, etc. When we'll be back, there would be a small story in Hindi, and then we will continue our class. So, Mr. Nisar, can we go for a break of 10 minutes? Okay, welcome back, everyone. I believe you must have your coffee, tea, etc. Okay, we are going to solve some MCQ also after 5 or 10 minutes. So I would like to tell you that you should have a pen, paper, and calculator because there would be some MCQ in which you need to do some calculation also. Okay, so till there is going to be a small story, you should get your pen, paper, and a calculator for the purpose of MCQs also. सो स्टोरी बहुत ही सिंपल है, बहुत ही इंटरेस्टिंग है और बहुत बहुत साल पहले की बात है। एक बिजनेसमैन था और उसका काम था कि वो जंगल से छोटे छोटे कीड़े कीड़े इंसेक्ट्स पकड़ के लाता था और उन्हें मार्केट में जाकर बेचता था दूसरे बिजनेसमैन को। और उन कीड़ों के बदले में, इंसेक्ट्स के बदले में उसको चाहिए होते थे फेदर्स। एक बर्ड होती थी, उसके पंख उसे चाहिए होते थे। उनको फिर वो दूसरी मार्केट में जाके बेचता था, वहां से उसे पैसे मिलते थे। तो उसका एक बिजनेस था। तो एक दिन जब वो जंगल से कीड़े इकट्ठे करके एक बॉक्स में ले जा रहा था, तो रास्ते में एक बर्ड मिली। उस बर्ड ने उसको पूछा कि आप ये कीड़े लेकर कहाँ जा रहे हो, क्योंकि उस बर्ड को वो पसंद थे खाना। तो उसने कहा मैं मार्केट जा रहा हूँ और इसको बेचकर मुझे फेदर मिलेगा और वो फेदर से मैं पैसे लूंगा। तो उसने कहा काम करते हैं, आप मुझे थोड़े से कीड़े दो खाने के लिए, ये बॉक्स दे जाओ, उसके बदले में मैं आपको अपना एक फेदर दे देती हूँ। तो उसने कहा ठीक है, गुड डील। उसने बॉक्स दिया, उस बर्ड ने अपना एक फेदर दिया, वो लेके चला गया। उस बर्ड की एक और फ्रेंड थी, उसने कहा ऐसा ऐसा एक डील है, तुम भी अपना फेदर दो। कीड़े पकड़ने में कितना मुश्किल होता है, खाना ढूंढना इट्स वेरी डिफिकल्ट, अपने बच्चों को भी देना होता है तो बहुत मुश्किल होती है। तो ऐसे करके हम पैसे कमा लेंगे, मतलब कीड़े ले लेंगे और हमें मेहनत भी नहीं करनी पड़ेगी। बट वो अदर जो उसकी फ्रेंड थी वो तैयार नहीं, उसने कहा नहीं, मैं ऐसे ही करके करूंगी, मुझे अपने फेदर नहीं देना। सेकंड डे भी वही हुआ, उसने फिर से एक फेदर दिया अपना, फिर कीड़े लिए, उसने बच्चों को भी कीड़े दिए। जो सेकंड फ्रेंड थी वो मेहनत से ये सब कर रही थी। थर्ड डे, फोर्थ, ऐसे करते करते धीरे धीरे क्या होने लगा कि उसके फेदर खत्म होने लगे, वो वीक होने लगी। और अब क्योंकि इतना टाइम हो गया था, तो उसको अब जो हंटिंग स्किल थे, उसके कीड़े पकड़ने के तरीके, वो भी भूल गई थी। और प्रॉब्लम इज दिस कि उसके बच्चों को भी वो कभी नहीं सिखा पाई कि कैसे कीड़ों को पकड़ा जाता है। जब सारे फेदर खत्म हो गए, तो उस बिजनेसमैन ने अब कीड़े देना बंद कर दिया। सो शी स्टार्ट स्टार्विंग, मतलब उसको खाना नहीं मिल रहा था और धीरे धीरे करके शी डाइड, दैट बर्ड डाइड। उसकी फैमिली के ऑफ कोर्स बच्चों के लिए भी लाइफ बहुत डिफिकल्ट हुई एंड दे आल्सो डाइड। सो टेक्निकली द मोरल ऑफ द स्टोरी इज दिस, यू हैव टू डू हार्ड वर्क, नथिंग इज फ्री इन दिस वर्ल्ड। तो if you are not going to do hard work for your future, so the future will be very difficult for all of us. If we think okay हम सीए नहीं करते हैं, कोई नॉर्मल पढ़ाई कर लेते हैं, ग्रेजुएशन कर लेते हैं, कम पढ़ना पड़ेगा और फिर 15-18 हज़ार की जॉब तो अभी मिल ही जाएगी। बट उससे आज की लाइफ तो आपकी चल जाएगी। 15-18 हज़ार में आप अपना इंडिविजुअल सर्वाइवल कर लेंगे, बट फ्यूचर वुड नॉट बी दैट इजी। फ्यूचर के जो ड्रीम्स है वो पूरे नहीं हो पाएंगे। सो यू हैव टू डू अ लॉट ऑफ हार्ड वर्क। द अदर बर्ड जिसने खुद से मेहनत करी, जिसने अपनी फैमिली के लिए खुद मेहनत करी, उन्हें सिखाया कैसे करते हैं काम, दैट विल सर्वाइव फॉर अ लॉन्ग टर्म एंड दैट वुड हैव अ ग्रेट लाइफ अहेड। सो आपकी लाइफ का सबसे इंपॉर्टेंट टाइम अभी चल रहा है। लाइक अभी के 3-4 इयर्स अगर आप मस्ती करते हो, पढ़ाई को उतनी इंपॉर्टेंस नहीं देते हो, तो व्हाट विल हैपन, बहुत बहुत प्रॉब्लम अराइज होगी फ्यूचर में। फिर पूरी लाइफ, नेक्स्ट 30-40-50 इयर्स यू हैव टू वर्क अ लॉट एंड दैट वुड बी अ लाइफ विदाउट required money, without required reputation, and life would be really difficult. It's not easy. Life is not fair for all of us. It would be unfair at times also. So you have to understand that अभी के 3-4 years डेडिकेशन से अपनी पढ़ाई करो। बहुत सारी चीजें आपको डिस्ट्रैक्ट करेंगी, दोस्त आपके घूमने जाएंगे, पार्टी करेंगे, बोलेंगे अरे पढ़ाई छोड़, देख लेंगे, कुछ और कर लेंगे, बट यू हैव टू बी वेरी फोकस्ड। डिस्ट्रैक्शन है सारे के सारे। एंड सी इज नॉट अबाउट कि आप पढ़ते कैसे हो, सी इज ऑल अबाउट सेक्रीफाइस ऑल्सो, कि आप बाकी चीजों से बचते कैसे हो। दो तरह के बच्चे सीए करते हैं। मैं अपने पुराने स्टूडेंट्स लाइव क्लासेस में जब फेस टू फेस पढ़ाता था, तो मैं सबको ये डायलॉग बोलता था कि दो तरह के बच्चे सीए करते हैं, एक जो सीए करते हैं और एक जो सीए बनते हैं। सो देर इज डिफरेंस कि आप करने वाले हो या आप बनने वाले सीए की कैटेगरी में आते हो। तो करने और बनने वालों में अंतर होता है। करने वाले सिर्फ करते रहते हैं, बनने वाले सेक्रीफाइसेस करते हैं, मेहनत करते हैं, आज की उस मेहनत का रिजल्ट उन्हें नेक्स्ट 40-50 ईयर मिलता है। जब आपको आपके साइन करने के भी पैसे मिलेंगे ना, हमारा ही प्रोफेशन है विच गिव्स यू मनी फॉर योर ऑटोग्राफ्स। देर इज नो अदर प्रोफेशन जिसमें आपको इतना इजिली ऑटोग्राफ करने के भी मनी मिलते हैं। इवन आवर प्राइम मिनिस्टर श्री नरेंद्र मोदी जी सेड that a CA sign is more powerful than my signature because it actually have that power. So that kind of recognition you have a great fraternity with you. ICAI having so much of renounced, uh, and we have so much of reputation also in this profession. तो अभी मेहनत करो 3-4 साल अच्छी तरह से सब कुछ छोड़ो and you would have a great life ahead. I have heard this story from my father. The morals, yes, of course, all stories, morals are same. Like all movies होती हैं, सब में सेम ही होता है. एक बैड होता है, एक अच्छा होता है, and अच्छे को बैड को खत्म करना होता है. So ultimately सब वही है. The story is just for your entertainment purpose that it might encourage you to understand that life में कभी भी कुछ भी शॉर्टकट से नहीं मिले. So अगर आप अपना हार्ड वर्क आज पुट करेंगे तो डेफिनेटली उसका रिजल्ट मिलेगा लेटर और सूनर. ओके. So moving on to the provisions, back to the work. We were on reverse mortgage. Now, reverse mortgage, why we are discussing reverse mortgage in this topic? Because there is nothing is going to be transferred. So point number 13 is all about transfer of capital asset under reverse mortgage. So under reverse mortgage, it has been just like a mortgage that if you have a property and you give it on a loan as a security to the bank for the purpose of loan. So that is called a normal mortgage procedure. Under normal mortgage, what will happen generally? Suppose if you have a property, suppose its market value is 50 lakh rupees and you do not have any regular income. So you went to the bank and you asked bank that please mortgage my property and give me some loan. Suppose bank is providing you 60% of this property as loan. That means you will get 30 lakh rupees loan. So is that loan is going to be your income or liability? Of course, the answer is it would be your liability. It would not be considered as your income. And now how you are going to pay that? You are going to pay that as in the form of EMI. Every month you have to repay that amount as EMI. So in case of normal mortgage scheme, what happened? We get the amount in lump sum. The loan would be in a lump sum payment and the repayment would be in installment, that is EMI. So that is a normal scheme. We call it a mortgage scheme. Reverse mortgage is just opposite of it. In the reverse mortgage, exactly the opposite mechanism has been used. How? Let me show you. Reverse mortgage scheme is only for senior citizens also. This is a special scheme framed by the banks. And what is the difference? Let me show you with the help of a simple example, a very simple concept. Technically, no capital gain provision is applicable on reverse mortgage because it's a kind of a loan in any way. So suppose Mr. A and Mrs. A is there. Both are senior citizen having a property and property value is suppose 50 lakh rupees. So in a normal mortgage scheme, if they'll go to the bank, suppose bank is providing you 60 to 70% of the value, like 30 lakh, they will get as a loan. And now they need to repay it as per EMI. Now the problem was that in case of senior citizen, they do not have any regular income. So what will happen? This 30 lakh would be consumed because it's a rule. If you'll get money in large quantity, you will have friends, relatives in large quantity. So जो भी आपके दोस्त रिश्तेदार हैं वो आपके पास आ जाएंगे. And when money is come in a large quantity, it will spend also very fastly or very rapidly. So might be this money would be end in some time, like in 5 years or 10 years, that would be gone. Then how they'll able to pay the EMI? So for those senior citizen, like this mortgage scheme was for everyone. But for if any senior citizen who apply for this mortgage scheme for their regular income would not take the benefit because in any way this money is going to be finished in 5 or 6 or 7 years by their kids, etc. So there would be again a survival problem because now there is no regular income and they need to pay EMI also. So there is no option to pay EMI because all regular income has lost. So for the benefit of those person, specifically a new scheme has been framed that is only for senior citizens. Only. Reverse mortgage scheme is for only senior citizen. Mortgage scheme for everyone. But in this scheme, those senior citizen having no regular income would be in a difficult position in future. But a reverse mortgage scheme, government understand that for the purpose of those senior citizen, we need to provide them income on monthly basis. So what they do, again, they have a property value 50 lakh. Banks say we will pay you loan of 60% of value. That would be 30 lakh rupees. But now the banks say we will not pay you this amount on lump sum. We will pay you this amount on a monthly installment. Suppose 25,000 per month we will pay you as a loan. So technically you will get 3 lakh rupees. You will get 3 lakh rupees in a year as a loan. So 25,000 per month you will get as a loan for your daily needs or for your survival purpose. And you not need to pay anything. You not need to repay it till you alive. So till you alive, you need not to pay anything whenever you will die. Both Mr. A and Mrs. A both. This is applicable for both cases. So when they both will die, at that time, bank will auction that property and recover their loan amount, 30 lakh with interest. After the death of borrowers, both senior citizen, bank will going to collect the amount of loan with interest on auction of that property, or if any of the legal heir comes and ready to pay the loan with interest, then bank will transfer that property in the favor of that legal heir and take the amount of loan and the interest at the time of after the death of assessees. So that was the logic behind the reverse mortgage scheme, that till the time you are alive, you do not need to bother about the regular payment of income. So now you might be thinking there could be a problem that in a year you will get 3 lakh rupees. So after 10 years, this 30 lakh would be finished, of course. So you might be thinking what happened if till 10 years nobody has died, or maybe Mr. A has died but Mrs. A is still there. So now how they will survive? So the scheme has been beautifully drafted, and you can understand after 10 years, the property value would be what? Increase or decrease? Of course, generally increase. Suppose it is now 70 lakh rupees. It would be more than that, but we are just taking suppose 70 lakh. So extra 20 lakh value has been increased. So 60% of this could be again allowed as a loan value. That means 12 lakh rupees again going to provide as installment for the survival. After 5-6 years, again it would be happen. So it is just opposites. Just understand the concept of mortgage, and then you can see the reverse mortgage is exactly the opposite thing, that you will get the money in installment, the loan in installment, and now the repayment would be in one shot. So in a normal case, you will get the loan at one time and you need to repay it monthly basis. Now this is a reverse case. You will get the loan in equally monthly installment. You need to repay it at once amount. Now, why we are discussing it under capital gain? Because there is a question arises that whatever amount you will receive as 25,000 per month or 30,000 or whatever amount, which you need not to repay back till you are alive, you need not need to repay back. So what should it be considered at, as income or as a loan? Because if it is an income, then it needs to be taxable under capital gain, because it's a kind of a transfer what is supposed to be, because you are transferring your right to the bank, that till the time you are alive you need not to pay anything, and after that the bank has the right to sell that property. So the question was that in the case of reverse mortgage, whether this 25,000 would be regarded as the income of Mr. A or Mrs. A or not. So what is the correct answer in of your opinion? Look, somebody asked the same question what I asked. Shruti was asked that what if senior citizen did not die for a long period? So it's resolved. Okay. I already understand what kind of query you are going to be asked. So whenever we are discussing a topic, just wait for the finishing of that topic. Because might be I'm going to take that query without even asking by you during the topic until I am going to finish it. Okay. So this loan amount will keep increasing as the year passes. Yes. So the of course the correct answer is okay. Shruti is saying that would be income. Harding saying not income. Aisha saying loan, not an income, not an income. Manvi saying income. Apurva is saying income. No, students, that would not be considered as income at all. No. Loan will still remain the loan. You need not to pay until you alive, but you have mortgaged your property. So something is going to be recovered from your asset. That is also a kind of a liability upon you. So how you can say that is your income? Income is something we need not to repay, whether myself or whether buy from my property. So ultimately your property is mortgage. So somebody is going to recover that amount, maybe not today, maybe after 10 years, or maybe when you die. But your asset is mortgage. So technically that would always be remaining a loan. The loan would remain a loan, of course, and as always. So under capital gain, reverse mortgage scheme, the time you are getting that income, it would not be considered as your income is specifically exempted. What will happen when the bank will sell that property? Whatever amount bank will receive at the time of auction, up to the amount of loan and the interest, that would be his PGBP income. The interest part would be the PGBP income of bank. And if any excess has been recovered, that would be the capital gain question in that situation. So you can see the provision has been discussed. Step 1, borrower hypothecate the house to the bank. Mortgage will not be a transfer, so no cap gain. Installment will not be regarded as income as exempted under section 1043. So whatever installment you will receive will not be regarded as your income. Ownership of the house will be the borrower. You will still be the owner. Okay. Now step 3, when borrower dies, house loan repaid by legal heir, house handed back to the legal heirs, or house sold by the bank to repay. If sold by legal heir, if sold that property in future, then capital gain would be applicable on that legal heir part. If bank will transfer that, then the interest portion of that loan would be your bank business income. Okay. So these are the provision. You can go through about the reverse mortgage, the theoretical part you can go through. There is nothing new. The questions are also here. For example, you can go through it. Very simple questions. If there would be any problem in this question, you can ask me. We have definition of amalgamation. If you want to know what is amalgamation, what is demerger, you can go through with these definition also. So 13 points have been discussed. Now we have point number 14 and 15. After that, we will solve the MCQs. Once we will complete this, point number 14 and 15, these are very simple. Any transfer by way of conversion of bonds or debenture into the shares or debenture of the same company, that is exempted capital gain. If you transfer by way of conversion of bonds or debenture into the shares or debenture of the same company, there would not be any capital gain. Any transfer by way of conversion of preference shares into the equity shares of the same company, that is also not a capital gain transfer. So if your bonds and debentures has been converted into shares or debenture of the same company, no capital gain. If preference share has been converted into equity share, again there would be no capital gain. No issue regarding the previous owner cost of acquisition, previous year period of holding. There is no issue like that. The clarifications talk about point number 14 and 15, how it need to be solved. The cost of acquisition of shares or debenture received on such conversion shall be the cost of that part of debenture or bond which is so converted. For example, you have purchased 1 lakh rupees debenture in 2010. In 2016, 60% of the value of debenture has been converted into shares. So out of this 1 lakh rupees, now debenture cost would be remaining only 40%. Now the debenture cost would be 40,000. Whenever they will sold the debenture, the cost of acquisition would be considered only 40,000 because the 1 lakh 60% part has been converted into shares. So when you will sell this share, cost of acquisition would be 60,000. So there is no previous owner cost acquisition case because assessee is not changing. But the clarification says if any part of that debenture, etc., has been converted into shares, then whatever amount of value has been converted, that would be the cost for that new shares. And the balance part which has been left would be considered the cost for those specific debentures. I will solve a small question regarding it. Do not worry. Period of holding will be counted normally. There is no specific rule like previous owner, etc. If preference shares converted into bonds or debenture, that would be capital gain. Only preference share conversion into equity share is exempted. If preference shares has been converted into debenture, etc., that could be chargeable to capital gain. So let me show you the simple example of it. Then we'll move on to the MCQs. Suppose Mr. A purchased 2000 debentures at the rate 100 each on suppose 2012. Out of these 2000 debenture, in the ratio of 2 is to 1, you get shares. And the total value was purchase of debenture was 2 lakh rupees. Out of this value, 60% converted into the shares value on conversion. So at the time of conversion, you get 2 is to 1 equity shares, and the value of your debenture 60% has been converted into shares. And this has been done in 2018. Now, conversion of debenture into shares is exempted capital gain. As per point number 14, we discussed because it is exempted capital gain. So, no capital gain treatment in this year, 2018. When capital gain will arise? When we transfer these debenture or shares both. Suppose we transfer, now how much share we have? We have 1000 shares because in the ratio we have received 1000 against 2000 debenture. So now I am having 1000 share, those 60% value is 1,20,000. And I am having 2000 debenture. Debenture number does not decrease, the value decrease only. Now the remaining value remaining is 40%, that means 80,000. So now the cost for debenture is remaining 80,000. Number will remain the same. The shares number is 1000 and the cost of the shares are 1,20,000. Now we transfer all debentures and shares. Suppose in 2024, date is 1st May 2024, we transfer all shares and debenture at the rate, suppose 400 each. And you have been asked to calculate the capital gain. So there is no assessee change. Assessee was Mr. A. Mr. A was having debenture and some part of debenture has been converted into shares. So there is no assessee change. There is no Manjula Desha provision. There is no period of holding concept problem. This is very simple question. So we will write computation of capital gain as we always do in the hands of Mr. A for assessment year 25-26. Now we have two assets. One we have debentures, other we have shares. So we have to find out the period of holding. So the concept says there is no issue in calculation of period of holding. Whatever you have purchased when, from that day till the date of transfer, you will consider it's a period of holding. So we purchased debenture in 2012. We purchased debenture in 2012. Okay, over here. So debenture period of holding would be 2012-2024. Shares we have received in 2018 on allotment, on conversion. So that would be from 18 2024. Long term. Long term. Okay. Next, we now need sale consideration. So how much debenture we have? We are having 2000 debenture and 1000 shares. So everything has been sold for 400 rupees each. So that means 8 lakh rupees and we are having this 4 lakh rupees. Now let's long-term assets we have and we have transferred before 23rd of July. So that would be index cost of acquisition. So what is the cost of acquisition? Now the cost of acquisition for debenture would be only 40,000 lakh or 80,000. It was, I guess, 80,000, sorry. 80,000 was that. And the cost of acquisition for shares would be 1,20,000. It's long term. We will multiply it with 363 and the index for the year in which asset is held by SSC will be taken. So shares he received in 2018. So 2018-19 index that would have been given in question we will take over here and deducted from this value. So that would be my long-term capital gain. Clear? A very interesting thing. Debentures not required indexation, not even before 23rd of July, only capital index bond and that original gold bond, they need to be indexed, not any other debenture needs indexation. So no indexation would be applied on debentures. So we will have our long-term capital gain 7,20,000 in this case. Okay, that was the case. If they don't have any income, they don't pay installment. In this situation, what will happen? They do not need to pay anything as installment, Anirudh, after the death of those senior citizen. From the property, the installment would be recovered. So that was the case. So we have covered all the exempted capital gain. Now we have the special provision, but before that, now we will solve our MCQs. So I believe you must have get your pen, paper, and calculator for those MCQs. I'm going to ask one by one. Where are the MCQs? Like starting, I guess 7, 8 MCQs are very simple. They are just theoretical. It will not take more than 10 seconds to discuss. After that, last 4 MCQs are numerical part. That required your pen, paper, and calculator. चलो MCQ करते हैं. That is MCQ number 1 for all of you. That is our moment of truth. Chalo. Very, very simple. Which of the following will be treated as long-term capital asset after 12 months? Of course, the correct answer is A. Listed shares will be treated as long-term capital asset after 12 months. Well done. Okay, second is if the goodwill of a business, trademark or brand name, right to manufacture, right to carry on any business or profession, tenancy right, route permit, loom hours is acquired before 1/4/2001. What should be the cost of acquisition of such asset shall be? So we are asking about intangible asset. If it has been purchased before 1/4/2001, okay, the might be a confusion because the answer could be A or C. So let me correct this. Acquired. So if I have written that is via self generation. If it is acquired as self generated, then what should be the correct answer? Of course, now because the question was not clear in this, so that the correct answer would be, of course, C. It's very simple. So it should be mentioned whether it has been self-acquired or it has been purchased. Which of the following is not a capital asset? I believe Devraj is also answering on the portal. Okay. Of course, personal movable assets are not treated as a capital asset. Well done. Transfer does not include extinguishment, gift, sale, or none. Little tricky question. Somebody is saying gift. B. We have C also. Answer. Okay. सारे दे दिए ऑप्शन आप लोगों ने A, B, C, D सब. So gift is a transfer. We have discussed in the definition of transfer under section 247. It is transfer. But it is exempted later under section 47. Extinguishment तो transfer की definition में है ही, उसको कौन option में दे रहा है. So of course the correct answer is D. All A, B, C has been included in the definition of transfer. Gift is also a transfer, okay? The cost of acquisition of the right share to a person who purchased the right to acquire the share from the existing shareholder shall be. What is the correct answer of question number 5? Hardik is saying C. Kasak is saying C. Kiran is saying C. Vedi is saying C. Of course, the correct answer is C. For the new shareholder, if he acquired the right from the existing shareholder, then whatever amount he has paid for acquiring the right plus the amount he need to be paid to the company for the offered price, that would be the cost of acquisition. Well done. If goodwill of a profession which is self-generated is transferred, there will what? Be capital gain, not be any capital gain, be a short-term cap gain, or none of the above. Self-generated goodwill means, of course, personal nature goodwill. So if it is a personal nature goodwill, because it's self-generated, that means it's my goodwill. So automatically they are trying to tell you that it is a personal nature case. So it would not be any capital gain. So the correct answer would be B, not be any capital gain. Rajat purchased a car for his personal use for 5 lakh in April 2024 and sold the same for 5 lakh 50,000 in July 2024. The taxable capital gain would be how much? Somebody is saying A, somebody is saying C, somebody is saying C. There is not loss in sale of this car. There is a profit on selling of this car. So what should be the correct answer? The correct answer would be A. The provision will remain the same, whether it's a loss or profit. The intention of government was if it's a personal movable asset, that it would result in loss. So they have removed that personal movable asset from the definition of capital asset. So now in practical life, even if you are having any profit, that would not going to be taxable. So the correct answer would be option number A. Now, question number 8. What is the cost of acquisition if a land is purchased on 1st April 2010 for rupees 10 lakh? Commission paid on purchase was 10% of purchase price and FMV on 1401 was 12 lakh. We are not discussing about the capital gain. We are just talking about the cost of acquisition in this case. So what should be the correct answer? Okay, somebody is saying C. इधर कौन है क्वेरी पोर्टल पे 6 तक पहुंचे बच्चे भी क्वेरी पोर्टल वाले ओके somebody is saying D somebody is saying C. The important thing to note in case of finding out the cost of acquisition is the date of purchase. So if the date of purchase is on or after 1st April 2001, in that case FMV is irrelevant. So only purchase price would be taken, that is 10 lakh plus 10% commission. So the correct answer would be option C. Now there would be numericals for you. Mrs. R sales a plot of land on 21st June 2024 for 50 lakh. She inherited the plot from her grandfather on 1st April 1995. Her grandfather had acquired the plot on 1st March 1981 for rupees 2 lakh. The FMV of the plot as on 1st April 2001 was 1,85,000. Compute the capital gain after applying Manjula J. Shah provision. Question number 9, you have to solve it. If you won't be able to find the correct answer, I will solve it for you. I generally ask the student that after seeing a question, do not try to solve the question completely in your mind. Just understand you need the different ingredients to solve that question. Like for a capital gain question, I have to find out first of all who is the assessee. So first of all, you have to find in question who is the assessee. Then the second thing is what is the period of holding, long term, short term. So you have found two parts. Now the third important thing is sales consideration. Then find sale consideration. Then go for the cost of acquisition or index cost of acquisition and find if there any cost of improvement or not. So when you arrange all these things in your place or in your copy or in the solution part, then try to solve it. Just after seeing the question, and if you think, okay, fine, I will solve it like this, like that, that's a wrong process actually. You have to find out the part what you need. So Hardik is saying it's D. Okay, none of the above. Okay. Anyone else? We have to apply Manjula J. Shah. As per Manjula J. Shah, we have to calculate. What cost of acquisition you have taken, Hardik? Others, those are answering option D. What is the cost of acquisition in your case? The cost of acquisition would be 2 lakh, not 1,85,000. Why 185? The FMV is 185, but the purchase price was 2 lakh rupees. 2024-25 index is 363. So the cost of acquisition should be 2 lakh rupees. If you have taken 1,85,000, so the answer would be wrong. Okay, chalo, I'll do it. Okay, देखो, say that heading part you will do. ठीक है? Assessee is Mrs. R. ठीक है? Now this period of holding is long-term capital asset. Now the sale consideration is 50 lakh. And now the cost of acquisition provision says the previous owner cost of acquisition. So previous owner purchased it for 2 lakh and in 1981. So I need to compare it with the FMV of 1/4/2001. So whichever is higher, the higher would be 2 lakh rupees. I guess most of you are taking 1,85,000. That's why the answer were wrong in the starting. Now 363 and 100 would be the index. So I guess that would come 7,26,000. So the correct answer would be 4274000. Okay, got it? So the correct option would be option number B. जल्दी नहीं करते हार्दिक, आराम से सॉल्व करते हैं, आराम से. There is no prize is waiting for you for giving answer jaldi. So in examination, I always say better to take 5 minutes and solve answer correctly rather than take 3 minutes or 2 minutes and solving it wrongly. What is the fun of those 2 minutes? Those 2 minutes has been wasted. Okay, chalo bhai. Question number 10. Mr. Sudeep purchased a piece of land on 14th January 1988 for rupees 1 lakh. This land was sold by him on 12th June 2024 for rupees 30 lakh. The market value of the land as on 1/4/2001 was 6 lakh. Expenses on transfer were 3 lakh on sale price. Please calculate the capital gain as per assessment year 25-26. Okay, Hardik ने कहा ऑप्शन नंबर ए, सुखवीर ए, सानिया ए, वैदेही ए, प्रकृति यादव is saying B. Very good. The correct answer is option number A. Like sale consideration has been given in the question is 30 lakh rupees. The expense on transfer we need to deduct 3% on selling price. That would be 90,000. So my net sale consideration would be 29 lakh and 10,000. Okay. Now index cost of acquisition need to be calculated. For the purpose of that, I have to see what should be the cost of acquisition. The cost of acquisition would be 6 lakh or 1 lakh, whichever is higher. So that would be 6 lakh into 363 upon 100. So that would come to 178,000 and 7,32,000 be my long-term capital gain. Okay, chalo. Two more to go. 11. Sudeep acquiring the property. Sudeep sir है मेरे friend है काफी. Might be he must have taken some lecture from a law subject. So his name is mentioned over here. Sudeep Jain sir. So Sudeep acquired the property in the previous year 82-83 for rupees 6 lakh and paid rupees 28,000 as registration charges. The market value of the property as on 1st April 2001 was 20 lakhs. Sudeep died. No, no, no. Very sad. On 25th 11 2017, and the property was transferred to his son Kishore. He is also one of my friends through inheritance. The market value of the property as on 25th November 2017 was rupees 50 lakh. Kishore sold this property on 30th June 2024 for 1 crore rupees. Compute the capital gain for assessment year 25-26 via applying Manjula J. Shah. Kasak is saying B. Wow, you sold so early. Very nice. Hardik is also saying B. Sania is also saying B. Anirudh is also saying B. Well done, students. High five from Wi-Fi. Chalo. देखते हैं, of course, again the heading part, the assessee is Mr. Kishore. Sudeep is previous owner. So everything would be from the point of view of Mr. Sudeep. Now sale consideration would be 1 crore. The cost of acquisition would be 20 lakh into 363 upon 100. So that would be 726,000. And we have capital gain 274,000. So option B is the correct option of question number 11. Okay, the last question. Sudeep acquired a land in 1987-88 for rupees 8 lakh and gifted it to Major son Kishore on 1st June 2000. When the market value of the land was 10 lakh, the fair value of that land as on 1401 was 12 lakh. Kishore sold that land on 25th April 2024 for 50 lakh. Compute the capital gain for assessment year so and so, etc. Kindly solved it. Okay, Hardik is saying option number A. Pranav is also saying A. Well done. Rashmi A. Sania is also saying A. Sukhveer is also saying A. Well done. Yeah, the correct answer is A. Same process, of course. Let me just write it down the provisions, the solution part, of course. Sale consideration is 50 lakh. Transfer expenditure has been given in question 1 lakh rupees. So there would be net sale consideration 49 lakh. Now index cost of acquisition like 12 lakh into 363 upon 100. So that would be 4356000 and remaining 5,44,000 would be your correct answer. So I hope it's clear, each and everything till now. Good. Now moving on to a small section, it's very small section, so we need to cover it we will cover it in 4 or 5 minutes. Then our class time will be over, I guess. And that is advance money forfeited under section 51. So it says, if in case of any transfer, you receive any money in advance. Generally, it happens in case of immovable property that you make an agreement with someone that I will transfer my property to you for rupees 50 lakh, and the buyer is going to pay you 1 lakh rupees in advance. Okay, fine, keep it this money 1 lakh rupees in advance, and we have make an agreement. Then within 6 months, you will pay me the rest of the money. And if you are not able to pay me the rest of the money, I will forfeit your amount. So generally it happens in case of immovable property, but this section apply in case of every capital asset. And it says if there is any advance money is forfeited by the assessee or any person, then the amount so forfeited will be treated as income from other source. So suppose if somebody has given me 1 lakh rupees as advance money and within a certain time he asks that I will get the registry done and I will pay you the rest of the money. And he is not able to do that. So I kept his money and I have forfeited that money. Then that amount is going to be taxable under income from other source and I have to pay tax on this. So that provision has been applicable from 1st April 2014 on or after 1st April 14. Before that, there was a separate provision that advance money forfeited would be deducted from cost when I will transfer that asset. So suppose if it is an example of before 1/4/2014, I have received 1 lakh rupees, I have forfeited it. So before 1/4/14, that is not going to be taxable under income from other source. Suppose I am going to transfer that asset to someone else after 20 days. So at the time of that sale, whatever the sale consideration I will receive, that would be my sale consideration. Suppose my cost was 10 lakhs. So now at the time of sale of that property, out of my cost, the advance money I have forfeited is going to be reduced. So now cost would be treated as 9 lakh. उसी का indexation करेंगे. But that is an old case. I don't think so that is relevant for your examination. That was far back, like 10 years before that was applicable. I'm just telling you because it has been mentioned in your study material. That's why for practical life, I guess only those provision would be applicable. Those are on or after 1/4/2014. So you can see the treatment. If advance money received and forfeited before 1st April 14, the amount of that money is going to be reduced from the cost of acquisition at the time of calculation of capital gain. But from now onwards, from 1st April 2014, if any advance money has been received, it is going to be taxable under income from other source under section 56(2), clause number 9. That was a section. Okay, two more sections, and that is again very, very easy to understand. So let's do this. Let's complete this section also. These are only regarding transfer of capital asset from a partnership firm to its partner or vice versa. So these two sections is just going to explain you that what should be the sales consideration. So what should be the sales consideration when a partner transfer his or her asset to the firm, or when a firm transfer asset to the partner. So what should be taken as the sale consideration? Because firm and partners are correlated, so there could be manipulation also. So to avoid those manipulation, to avoid the avoidance of tax, the department head makes this clarification under section 45(3). This talks about the sale consideration in this case, and section 45(4) talks about sale consideration in this case. Very simple provision. It says, in this case, sale consideration would be the book value at which that asset has been recorded in firm's books of account. So when you transfer your capital asset to the firm, suppose the asset market value is 10 lakh. But firm record that asset in the books of account for rupees 8 lakh. So what we will treat, sale consideration would be 8 lakh. Or firm record it at 11 lakh rupees. Then for the purpose of partners, sale consideration would be taken as 11 lakh rupees. As simple as that. When firm will transfer that asset to the partner, then sale consideration would be fair market value. Suppose the book value in the firm's books of account at the time of transfer is 6 lakh rupees. Firm transfer it to the partner for 8 lakh rupees. But the fair market value is 9 lakh rupees. So what would be the sale consideration? 9 lakh rupees. All other provision like period of holding, indexation, etc. would remain the same. Only the sale consideration special provision has been explained in these two sections. You can see very simple provision. Shall be chargeable to tax in the previous year transfer took place, the amount recorded in the books. You can see how to solve this very simple provision. Same in case section 45(4). Now, scope and year of chargeability of section 45. So these are some special provision you might have remembered that at the time of definition of transfer, there was a case of conversion of capital asset into stock in trade. And I have told you that we are going to discuss this under section 45(2) in detail. Then we will discuss those provision in detail. So that is the provision we are going to discuss later in the next class. Then we have compulsory acquisition provision also there, destruction provisions also there. So that needs to be completed in next lecture. That would be, I guess, on 2nd of December. So if you have any query, kindly ask me. And if there is no query, then we will going to conclude this session. Okay, there are queries. Let's see. Hardik is saying, sir, one request. Can you please make a question after 23rd July 24 amendment or request? Yes, of course, I will do it. Today we will discuss how to solve those questions. Those are before 23rd of July. Because after 23rd of July, it's very simple. You need not to do any indexation. You need not to do apply Manjula Jesha. Nothing is required. Yes, for the purpose of tax calculation, we have to do that and we have to apply the rate. That we will discuss in the part 2, that how to apply the rate. But let me tell you, in the examination, it's a very less probability that they're going to ask you a question after 23rd of July 2024 in case of long-term capital asset. You know why? Because there is nothing to do. That would be like a short-term cap gain. You just need to deduct the cost of acquisition. No indexation, no index, nothing is going to be done though. But we will solve it. Okay. Next is Larry is saying, sir, any expense incurred on the transfer asset by the previous owner will not be available as a deduction for the current SSE, but cost of improvement incurred by previous owner will be available as deduction to current SSE. Yes, of course, exactly. If you'll see in the point number 1 or a clarification number 1, after the indexation provision, it has been written, any cost of improvement which has been done before 1st April 2001 will be ignored. And the next line after that is saying, any cost of improvement done by assessee or previous owner. I did not explain that word of previous owner there intentionally because I know you would not understand what is the meaning of previous owner. Because previous owner you will come to understand when we discuss the provision of Manjula Desha, etc. So if you will going to study that point again, so it says the cost of improvement done by the previous owner or assessee on or after 1st April 2001 is going to be allowed as a deduction. Absolutely correct, Lahiri. Okay. I will upload the MCQ also, not an issue. I'll upload with the answers. Kumbeshwari, today class amazing. I understand all this. Thank you so much. But let me tell you, every class is amazing. If you will keep your interest over in this class, definitely it's going to be study and the anything you are doing for your future. That is interesting. Always remember that whatever you are doing, whatever you are studying, whatever book, whatever solution, whatever question, whenever you feel there is any difficult question, treat it as your dream. Like it's not a question, it is your dream, it is your future, and you have to solve it. Only you are the one who is going to solve it. Okay. So I guess new scheme syllabus not available for capital gain. Everything is on capital gain on the portal. You can find it over there. It is on ICAI site. You have to log in on the ICAI BOS knowledge portal with the all notes, study material, etc. has been uploaded there. If there's any confusion, kindly mail to the Board of Studies. They will send you the link, etc. Also, there's a BOS app also. If you download the app, you will get each and everything on that app only. Okay. Okay, fine. So I guess there is no more query. So I guess we should conclude the session. So Nisargji, can we conclude the session? Can we close the class? Welcome everyone. निसर्ग जी आप हैं कॉल करूं